A few weeks ago, President Bola Tinubu signed 4 major tax bills into law. They are now being described as the most comprehensive tax reforms in Nigeria's recent history. Though passed as 4 separate acts, they work together to change how taxes are collected and how the government interacts with individuals and businesses on tax matters. The laws are meant to boost revenue and create a system that is fair, digital, and more efficient. These new laws include the Nigeria Tax Act, the Tax Administration Act, the Revenue Service Act, and the Joint Revenue Board Act. So, what do these reforms mean for business owners, salary earners, remote workers, and everyday Nigerians? Let's break this down. Tax conversations often feel complex and intimidating, but these laws aim to do the opposite. So they simplify, unify, and modernize Nigeria's tax landscape. Some analysts say they make it fairer for individuals and businesses, and even the economy as a whole. One of the major changes is the new income tax threshold. Anyone earning up to 800,000 naira per year, which is about 66,000 naira per month, is now completely exempt from paying income tax. This is a significant shift from the old system where earning just 300,000 naira or more annually meant paying at least 7% in taxes. Those earning more will pay tax based on a sliding scale, up to 25%. Also, if someone loses their job or gets injured, they won't pay tax on compensation, up to 50 million naira, up from the previous 10 million naira. Secondly, the value-added tax rate stays at 7.5%, but essential items like food, medicine, school fees, and electricity are now VAT-free. However, businesses selling them can still recover their VAT costs. In addition, VAT revenue will now be shared more with states and local governments, having 10% going to the federal government, 55% to states, and 35% to local government areas. The share for states and local government areas will be split based on equality, population, and where the VAT was paid. Small and medium businesses stand to gain some ease from these reforms. Any company making less than 100 million naira a year and owning fixed assets under 250 million naira won't have to pay company income tax, capital gain tax, or the new development levy. This is a jump from the old 25 million naira limit and is meant to ease the burden on small businesses so they can save money and grow faster. For individuals engaged in digital or remote work, especially those earning income from abroad, the reforms bring new expectations. Anyone residing in Nigeria and receiving foreign income is now required to register with the state tax authority. They are meant to declare that income in naira and pay personal income tax accordingly. This applies whether the funds are received via Nigerian bank accounts, fintech wallets like Pioneer or Wise, or any account linked to a bank verification number. The Federal Inland Revenue Service and the Central Bank of Nigeria now have the authority to track these inflows. Furthermore, Nigeria is now working more closely with other countries on tax matters. So if an employer in the US, UK, or another country sends money to a Nigerian resident, that payment may be reported automatically. Companies will also see a change in their tax requirements. For instance, the capital gains tax, which is a tax charged on the profit made from selling assets like property, shares, or investment, has increased from 10% to 30% for companies. The reforms have also streamlined company taxes by merging several sector-specific levies like the Education Tax, Naseni Levy, Police Trust Fund Levy, and NITDA Levy into one 4% development levy on accessible profits. Taiwo Ayodele, chairperson of the Presidential Fiscal Policy and Tax Reform Committee, said the reforms will improve the efficiency of tax collection and harmonize the taxes companies have to pay. The administrative changes are just as significant. The new Nigeria Revenue Service, NRS, will take over from FIRS with more independence, better efficiency, and greater transparency. It won't just collect taxes, but also other government revenues. To avoid double taxation and improve coordination, a joint revenue board has also been set up to ensure federal and state tax bodies work together. To strengthen taxpayer rights and accountability, 2 new mechanisms have been introduced: the Tax Appeal Tribunal and the Tax Ombudsman's Office. The tribunal offers an independent forum for contesting tax assessments, while the Ombudsman's Office gives individuals and businesses a way to report unfair treatment or harassment by tax authorities. These additions help build a more balanced relationship between tax collectors and taxpayers. Penalties for tax non-compliance have been made much stricter. Failing to file returns now attracts a fine of 100,000 naira in the first month and 50,000 naira for every extra month. New penalties include a 5 million naira fine for awarding contracts to unregistered taxpayers, as well as fines for refusing access to tax technology or trying to influence tax officials. The reforms also enhance the use of technology. VAT payments will now be tracked through mandatory e-invoicing and a system called fiscalization. This requires that receipts and tax records be generated using a government-approved digital platform, a move aimed at reducing fraud, increasing transparency, and making it easier for businesses to reclaim VAT already paid. Although the legal framework is now in place, most of the reforms will not take full effect until 2026. This transition period gives businesses and individuals time to prepare. Now is the time for businesses to take a close look at how they handle taxes, from reviewing current tax strategies to updating compliance processes and making sure internal accounting systems are ready. These reforms are designed to make Nigeria's tax system simpler, fairer, and more efficient. If implemented effectively, they will ease the burden on small businesses and low-income earners, hold larger companies more accountable, and move the country towards a more transparent digital tax structure that supports long-term growth.